Welcome to TheoTrade. It's Don Kaufman. It's October 11th, 2019, and you are watching the TheoTrade Weekend Update. Yeah, I'm live. I'm outside here in Payson, Arizona. It's cold, people. Let's get right down to business with this week and kind of give you a quick update of some of the action that we saw. There's also a lot of breaking news. Literally, as I record this, there's tremendous breaking news on the trade war front. I mean, this week and moving forward, it's literally pick your poison about what's going to create the next bout of volatility. You want to talk about earnings? Because earnings are coming up, of course, this next week. We're going to kick it off with the financial stocks. We've got Netflix coming out. It's a party, people. And I'm going to show in a couple of moments, we get to a couple of charts and a few trade ideas that earnings, they are so very going to matter this time around. What I'm saying is, you know, the last couple of trading weeks, it's been all about correlation. Nobody's really cared. Nobody's even thought like, oh, Apple, they had a new phone. That's like the only stock that we've really ever heard about. Roku, what's it doing? I don't know, it's a little tiny thing that's just exploding up and then fell down. But we haven't heard that much about individual stocks. I'm going to make the argument that earnings and earnings per share is going to matter this time around. And specifically, they're going to be looking a lot, okay, at some of the top line revenue numbers. So I'll push that aside again until we get to some of the charts and some of the trade ideas. But as I said, kind of pick your poison. On to the next. So we've got trade war and there's breaking news. As I said, as we're speaking right now, there's breaking news. It looks like phase one of some type of a trade deal might be in play right now. Of course, we've been here before, people, but that doesn't even matter. It doesn't matter whether this trade deal works out or not. One of the key elements that I want to kind of impress upon you is that the S&P 500, I mean, the thing exploded up. This is Friday afternoon. There were times where the S&Ps were up 50 S&P handles throughout today's trading session. And yet when the deal kind of got announced, the S&Ps actually sold off a little bit. We finished up, no doubt, we finished up on the trading day. But net, we only finished up mildly on a week that had so much anticipation. I mean, this week is just, if you traded throughout the course of this week, you're battle scarred. I mean, you had a huge down day, and Monday, Tuesday, we actually big follow through to the downside. Wednesday, Thursday, Friday, we ripped to the upside. Volatility is pretty much the name of the game. And something I'm going to explain here again in a few minutes is I believe that you're going to see an ever expanding range in terms of historical implied volatility. And that has everything to do with the reality that we are still very much range bound. We're trapped. I will get to specifics in a moment in the charts. For those of you that do follow us here at TheoTrade, you know that we have gravity points, and really these gravity points, as long as those are in play, okay, and that we're channeling between these gravity points, there's still a lot more volatility to come. So as I was saying, when I go back over here to pick your poison, so earnings, again, earnings are going to matter. Of course, the trade deal, and the trade deal is in play. That's just going to be plaguing us for weeks and weeks to come. I just saw a headline a moment ago. It said it's about 5 weeks to get a deal in place. 5 weeks just to write the thing? And this is only phase one. I know, it's very complicated. All right, so push that aside. What else do you have? You have the Fed. We're going to be worrying about the Fed again because Fed speak has been going nuts lately. There's even been dissension in the ranks in the European Central Bank. Typically, when the European Central Bank announces something like their version of quantitative easing, it's unanimous. Well, right now there's dissension in the European Central Bank ranks. That is, okay, their equivalent of their Fed presidents. Several of them have actually come out and been heavily against the idea of quantitative easing. And that's not only is it unusual, but Mario Draghi, who heads the ECB, he's done in a couple of days. Literally, end of October, his term is over. Christine Lagarde is going to come in. She's known to be the dove of all doves. That effectively means she wants to go negative interest rate policy deeper. She wants to go more quantitative easing. But again, there's dissension in the ranks. There's big fights coming with the central bankers over there. So when I say pick your poison, I mean it. Listen, people, there is a tremendous amount to think about in the very near future. One of the things I'm going to explain, okay, when I kind of get to the charts, to the trades, listen, this is not a time to take tremendous risk. Define your risk, keep your hands and feet inside the vehicle at all times because we're expecting ever expanding volatility. With that, let's get to it. A couple of charts, a couple of trade ideas. To the charts and trades we go. To stick with the theme of this weekend's update, pick your volatility poison. Well, I'm going to kick it off talking a little bit about the trade war. Listen, on the entire week, let's just talk about net what happened. Listen, right here, okay, that amounts to the week that we just passed through. And that central point right there on your chart, that's where the week started. And ironically, after all the volatility to the downside, all the volatility to the upside, I mean, come on, net, okay, it's a negligible upside, okay, week. And that really is it. But you know, on the front of this trade war, and by the way, it's a completely tweet-happy week. There's still tweets coming out here in the after hours about this phase one of the trade deal. I break it down to, again, it's buy the hype, sell the deal. What that kind of means is if you take a look at the S&P futures, and I'm going to go all the way to the intraday basis. Well, this is when things kind of got hyped up. I mean, listen, all of this is hype on the trade deal. This is actually the trade deal being effectively announced and us coming down heavily thereafter. And that's why I kind of call it buy the hype and sell the deal. But there's so many unknowns on this particular front. That's why I kind of call it picking your volatility poison. I'm going to leave the trade war at that, okay? Too many unknowns to try to sit here and to handicap, all right, that particular move, nor am I, again, going to attempt to. So the next point that I want to make on this weekend's update is about gravity, these gravity points. And we've been talking about gravity points, okay, literally ad nauseum. For those of you, if you are brand new, again, brand new to TheoTrade, we have highly specified levels inside of the S&P 500 E-mini futures. Now, bear with me because I say this every single time as a little bit of a disclaimer. I know that not everybody necessarily looks at futures contracts. I'm not saying you have to trade futures, okay? But I will say this. If you don't look at futures contracts, you should look at futures contracts because they drive order flow, okay? Especially in markets that have heavy correlation. What is correlation? Correlation, okay, is when I pull up, for instance, this visualize, okay? Now, this is specific to thinkorswim, and I reset everything because I go to visualize, okay? I change it from a heat map, and I come over here to index watch. Then I pull that up, come all the way down to a public list. When I say a public list, something like the S&P 100. Correlation, okay, is when the market is moving, okay, well, relatively as a whole, as one unit. And the gravity points become imperative when you are seeing heavy degrees of correlation, because when things are heavily correlated, let me tell you something. Nobody cares about individual stocks. Not Amazon, not your Facebook, not your little Apple over here. Nobody cares what the individual stocks are doing because the markets then are driven, okay, by the futures, meaning that big trading firms, they fire into the futures contracts first and everything kind of follows suit. And that's done, okay, by a means of server-driven markets. It's called statistical arbitrage. So these gravity points, okay, are generated by very large trading firms. How? Why? These large trading firms, okay, trade a tremendous number of option contracts, and they're constantly rolling these option contracts over. And these gravity points are almost like seams, if you will, okay, in the risk. So when we're actually pinging back and forth from the gravity points, you got to recognize, all right, all that is just volatility. Okay, it's just volatility coming out. We hit one gravity point, we rip to the next, we come back down again. And when you're pinging back and forth between these gravity points, it speaks volumes. Again, volumes about the market, which I'm going to get to here in just a moment. But the gravity points are what I term, it's a light in a very dark volatility tunnel. Because when we're seeing these tweets come out, when we're seeing news like big earnings and the Fed talks, all we're doing, at least at this point in time, as I said, is pinging back and forth between these gravity points. You know, it doesn't look like that much right now, okay? But we are adhering to these points literally like glue. When you start to look at a chart on a kind of reduced time frame, this is a 180-day, 4-hour chart. you can actually start to see us literally stopping at particular gravity points. Those become huge, okay, kind of pivotal points inside of trading sessions, including, of course, even today's trading session. In fact, this entire week, these gravity points became in play all the way down. We can go back weeks, months, literally, okay? You can go back years to see some of these gravity points effectively in play. Now, again, why do I say they're a light in a dark volatility tunnel? In a marketplace that feels incredibly chaotic, okay? All you do is recognize that this will be a stopping point along the way, and it can help you in mitigating your risk. So use them for just that. And I know somebody inevitably is going to ask me, do we have a gravity point above 29.83? And the answer is I do not. In fact, the 29.83 is our most recent gravity point. And I wanted to spend just a few minutes on that because they're essential moving forward. Why are they so essential moving forward? Well, this is where things start to get a little bit more interesting. Okay, we're still, okay, volatility and range bound. Volatile and range bound. What am I really referencing by saying that we're volatile and range bound? Well, if you look back at just the last few months of trade, all right, things, again, very fast, very chopped out. The ranges that we're seeing on an intraday basis. Listen, you can't ask for more as a trader because we're getting substantial moves. But I must stress this very idea. Right now, again, we're volatile, but as I said, okay, relatively range bound. Again, kind of trapped between some gravity points or, okay, in the midst of a very substantial volatility box. Now, in a situation like this, listen, sooner or later, we're going to rip these ranges apart. You know, one of the points that I will also make about these gravity points is that you have to recognize, okay, how efficient the market is right now. Even though that we're volatile, everybody's like, oh man, I'm getting my head ripped off by this next tweet. Okay, yeah, except that we have specific points that we're able to pick out. And I'll zoom back out for a second, and we're hitting it smack on target. That reeks of how efficient the market is. Not that the market is like insane, it's totally schizophrenic, okay? We're volatile, but we're in a given range. When things are gonna get dangerous, because that's why I say keep trades defined and keep your hands and feet inside the vehicle at all times. That's something I just said on the other video portion a moment ago. I cannot stress enough when we start to crack, okay, through the ranges that we've been in more recent times. Let's start calling it, let's pull numbers. Let's start saying, like, if we cracked below 28.11, okay, I mean, it's going to get downright nutty in this marketplace. And until we have to stop adhering to these gravity points, that's when things will start to break down, when really big opportunities are going to open up. But we still have that threat, if you will, okay, for an upside move. And I don't want you to look at this marketplace as there's nothing but downside over here. I emphasize, all right, pick your volatility poison. Nevertheless, the Fed, well, they're on the accelerator, and you know, hey, listen, anything is possible and plausible. However, I will still maintain bearish positions because I like the risk reward. And when I talk about risk reward, okay, I'm emphasizing again, we could absolutely break out to the upside. But a breakout to the upside, even though it could be vicious, and I'm going to even draw it on the screen for a second, that breakout to the upside could be vicious. The downside opportunities I still view, okay, as far more substantial. So from a risk reward standpoint, out into the future, I still maintain a very bearish take on the markets. All right, moving on over here. Historical volatility is only going to increase when cracking the range. Well, that is easy enough. Listen, when we crack outside of these gravity points over here, as I said, it's going to get downright nutty. Historical volatility is actually going to increase. The reason I mentioned historical volatility, that's actual price movement in the marketplace, is because you almost have to redefine volatility lately, because we're getting volatility to the upside as well as the downside. It's one of the reasons that we started using this trade called the infinity spread. All right. Next on the list, on the docket over here, you're facing earnings. Earnings. Last few weeks, and I was saying this a couple of minutes ago, but the last few weeks, no one has noticed, no one's cared about individual stocks. Oh, I know. Again, people are like, but what about Apple, Don? Okay. What about Apple? It's breaking out to new highs, man. Yeah. You know what? So the market actually ripped to the upside and Apple is just following suit. Oh, I know. It's going to be a spectacular quarter, but listen, I'm just picking on these stocks. It's all right now about correlations. But earnings are going to change things because now, and we're going to hit a little bit of a lull, okay? If you looked at some of these pain points up above, the trade war, that news is going to subside temporarily because they're going to spend like 5 to 6 weeks just hashing out, portions of this deal. The Fed is going to go quiet very soon because the next Fed meeting is going to be on October 30th. So the Fed, in the next 2 weeks, hits their silent period. That's when they don't talk. Okay. Thank you. Please don't talk. So earnings are going to come into scope. And all of a sudden, everybody's going to start caring about, again, there's top line and bottom line. I believe that we're going to start looking at like top line, like, hey, is Apple going to make as much money as last year? Because that's all they're going to care about, right? Are the banks, how are the banks performing in a declining interest rate environment? Again, like, JP Morgan, bestill my heart. How are they going to do out there? All of a sudden, with nothing left to worry about, they're going to start worrying about numbers again, okay? Keep it in mind because you're going to hear about it extensively this next week, and the markets are going to start to move on that. And I'm telling you, earnings season right now ain't exactly shaping up to be something, spectacular. There's going to be a lot of risk out there in some of these individual products. All right, let's move now to the mother of all products. If you've never heard me call it that before, that's the SPX, the mother of all products. So right off the bat, listen, last week, okay, 53. Next week, 51. What am I talking about? What's 53? What's 51? I'll tell you what it is, okay? I'm talking about expected move. Okay? The expected move for the entire next week is going to be 51. Now, time out for a second, cruise over to a chart. We're going to kind of zoom in here. So as I was saying, okay, listen, the entire week, this is the previous week, at middle line is where we started. Net, we had a very, very mild up week, okay? The point, though, of me clarifying last week's expected move, that was $53 higher or lower. And next week expected move, which is 51. One of the things that should surprise you about this is that this coming week, the expected move is 51. Why should that surprise you? Because one of the biggest events in recent history just occurred, right? You just had China. They met with the U.S. administration. They've had their little tiff, their little whatever you want to call it, the soiree. They got along. How come the volatility is not subsiding? And it continues to kind of resonate, which also, okay, clarifies some of my statements up above that gravity points are your light in a very dark volatility tunnel. So I stress to you once again, the volatility out there, yeah, you look at the VIX, the VIX is down a little bit, okay? The VIX came down, but next week's volatility isn't down. I also was taking a look still at the VVIX, that's the volatility of the volatility index, all right? So what does the VVIX say? The VVIX, okay, we're still trading in Never Never Land. In fact, the VVIX even retracted back up in today's trading session. So once you think the volatility is gone, it's not surprised. That's the point of me getting into expected move. If expected move says that the risk, okay, this next week is about the same as the week we just passed through, then holy crap, because we just saw a lot of risk this past week. And the week before that was just downright nutty. Okay, and here we go again. So more risk, one more week. Now, last but definitely not least, it's just the bear in me. I wanted to reiterate a couple of some of what I term the most advantageous positions. These positions, though, are duration. Let me clarify, duration out more than 3 months. Plain and simple, I like the XHB. I like bearish positions in the XHB. Okay, this is actually the entire chart pretty much on the XHB. I pulled up 20 years, but there isn't even 20 years of the XHB. But XHB approaching very close to all-time highs here. I am maintaining a bearish position in here. And that bearish position, I want to reiterate, it's not for tomorrow, it's not for next week, it's not even for next month. I'm going to be holding that position a minimum of 3 months. But I've already been in it that long. Okay, I like it. I want to sustain it, even if I have to take a little bit of heat in the near term. The next one on the docket over here. Okay, by the way, the XHB home builders, come on. The economy tanks. You think the home builders are going to do well? Yeah, I don't want to clarify too much on that front. Next one, the financials. The financials, oh, come on. They're just Mr. Toad's wild ride. The financials haven't done anything really lately other than ping back and forth between 28 back to 26.50. I'm going to reiterate a bearish stance here. I'm just going to pull up the max chart, okay, to really just kind of display a point. The XLF, all right, it still hasn't even gotten back to where it was, you know, in 2007, 2008 timeframe. However, okay, I really like the risk reward here as we're facing again a zero interest rate environment. Okay, it does appear that the Fed is going to continue with the foot back down to the accelerator, lowering interest rates. That's not going to be good for the banks in the future. Okay, last but definitely not least, okay, we're going to look at the XLP, and I'm just reiterating these again. Duration position here. This is no different than XHB and XLF. It's about a risk reward. If I pull up kind of a maximum chart over here, you would think, okay, that XLP, if you're not familiar with this, it's consumer staples. Okay, have they figured out like the cure for cancer over here? Look at this. The year-to-date percentage is up 20%. Okay, you have consumer staples outperforming almost all major sectors right now. And, you know, I poke fun because you're looking at something like Walmart up 28%, right? It's bothersome. Forget the 28%. It's a 0.4 beta, low beta, which is supposed to be, you know, the quintessential of, like, for instance, low risk. Low beta has become higher risk. Now, with these positions, just the bear in me, the XHB, the XLF, the XLP, I am using the ETFs right now for a very specific reason. I don't have any gap risk. I don't have to worry about earnings, but I also like the idea, okay, of using deep in the money puts as synthetic stock replacements, and the ETFs maintain so much liquidity. It's just easier and cleaner to do so. Listen, there's a lot to think about in terms of volatility, okay, in this weekend's update. A lot of different products to look at. Earnings are going to kick off. We're going to be talking extensively in the next couple of weeks about some earnings and earnings related trades, specifically earnings butterflies. Stay tuned throughout the course of this week. I'm going to take a couple of earnings trades early on in the week. We're going to look to substantiate a little bit of risk and net, okay? Again, keep your hands and feet inside of the vehicle at all times. We are expecting more volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.